The cruelest thing about compounding is not that it is slow. It is that for a long time it looks almost insulting. That is the part nobody explains honestly. They show you the chart. They show you the smooth curve that starts near the floor and then rises toward the sky, as if wealth were simply a matter of opening an account, remaining patient, and trusting mathematics the way a child trusts gravity. What they do not show you is the emotional experience of the first stage. The first stage does not feel like wealth building. It feels like disappointment with a brokerage login. You put money in, you wait, you look, and what you see seems too small to justify the seriousness of the effort. That is where most people quietly abandon the whole enterprise, not because compounding is fake, because it begins by offending the human ego. I have spent most of my life around capital, and I can tell you something very plainly. The majority of people who fail to benefit from compounding do not fail because they lacked access to a chart. They fail because the early years of compounding do not emotionally resemble the later years everyone uses in the advertisement, and human beings are not built to worship invisible progress for very long. A man will go to the gym for 6 months if he sees his body changing. A woman will keep practicing the piano if the music begins to sound recognizably better. An investor will continue if the effort looks like it is turning into something he can feel. But if the output stays embarrassingly small while the effort remains steady, the mind starts asking dangerous questions. Is this worth it? Am I doing something wrong? Did the whole world exaggerate this? Should I be taking more risk? Should I stop? Those questions cost more fortunes than bad stock picks. The source text you gave me puts its finger on the same discomfort from the opening lines. It says there is a floor, a minimum level below which compounding basically does nothing for you, and that most people are investing below it without knowing. Fay turn 51, file 0 Fay. That sentence is strong, perhaps stronger than I would phrase it, but the instinct is right. There is a practical threshold below which compounding is technically happening, but emotionally invisible. And emotional invisibility is a real enemy, because a financial plan that requires a normal human being to remain excited about results he cannot yet feel is a plan that will suffer terrible dropout rates. I want to explain this in a way the average person can carry into his own life, not as a formula, as a sequence. There are 2 engines in wealth building. The first engine is contribution. The second is compounding. At the beginning, the first engine does almost all the visible work you save. You invest, you move $200 or $300 or $500 or maybe less into an account every month. At the end of the year, the gain from market returns looks small compared with what you personally added. That is not a flaw. It is the correct outcome of a small base. And yet people are surprised by it every year because they were shown the ending before they were taught the middle. I want to give you the middle. Let us begin with something humiliatingly small. Suppose a person invests $50 per month into a broad index fund and earns roughly 8% annually over the long run. The source text uses this exact sort of example because it is honest enough to make people uncomfortable. After a year, the return is trivial. After 5 years, the accumulated value still does not feel life-changing. Even after decades, the number may be respectable, but not transformative in the way the charts make beginners imagine. Fay file a site, Fay turn 51 file 0 Fay. That is not because compounding lied. That is because the base was too small for the percentage to matter in an emotionally visible way. 8% of a tiny number is a tiny number. There is no moral lesson in that. It is arithmetic. Arithmetic does not care how inspired the saver felt. It only cares about size. This is why I have always thought one of the most useful sentences in finance is also one of the least glamorous. Percentages are only impressive when they are applied to something big enough to matter. That is it. 8% on $10,000 is $800. 8% on $100,000 is $8,000. 8% on $1 million is $80,000. Same percentage, completely different life. People talk endlessly about the rate. I care a great deal about. The pile determines whether the rate becomes a noticeable servant or a decorative statistic. The source material gets this exactly right when it says that wealthy people often seem to get richer without doing much because they already have a large enough pile that the same percentage produces meaningful absolute dollars. Fay fill a site, Fay turn 51 file 0 Fay. That is not unfairness in the narrow mathematical sense. It is size. The market does not care whether a person deserves to feel momentum. Momentum appears when the base is large enough. This is also why the early years are so psychologically dangerous. A beginner here starts small. That phrase is useful and true in one sense. Starting is better than not starting. A small contribution is better than no contribution, but the phrase is also abused because it creates an emotional impression that any tiny amount, if carried dutifully, will soon feel powerful. Often it does not, for a very long time. That is where the dropout happens. The source text is again right to say that what really destroys many beginner investors is not that compounding fails, but that they do not understand why it feels pointless for so long and therefore conclude that the process itself was overhyped. Fay file cite Fayturn 51 file 0 Fay, that is the key psychological risk, not ignorance of finance in the academic sense. Misreading the experience. And once you misread the experience, you begin looking for other explanations. Maybe the returns are too low. Maybe I need better stocks. Maybe I need crypto. Maybe I need to trade. Maybe I need leverage. Maybe the whole passive investing idea is a lie. In many cases, what you need is simply a larger contribution base. That is much less sexy than a new asset class. It is also much more useful. The public loves to talk about return because return sounds sophisticated. I have always preferred to talk first about contribution, because contribution is where the beginner still has direct control. He cannot control market returns. He can influence what goes in. And in the first phase of wealth building, what goes in matters much more than what the market adds on top. That statement surprises people because they have been taught to worship yield. But run the numbers honestly and it becomes obvious. The source text does exactly that with multiple scenarios, comparing $50 per M-onth, $200 per M-onth, $400 per M-onth, and then larger amounts over long periods at roughly 8% annual returns. Fay-Felicite Fayturn. 51 file 0 Fay, the conclusion is not subtle. At very small balances, increasing the contribution often matters far more than chasing a slightly higher rate of return. This is one of the great misunderstandings of beginner investing. People assume the core problem is not enough return. Usually the core problem is not enough fuel. Suppose you are investing $200 a month. You are diligent, you are consistent, you look at the account after a year, and the gain from market performance is still unimpressive. This is the moment where many people start fantasizing about a smarter portfolio. They say, maybe I need 15% instead of 8. Maybe I need a more aggressive strategy. Maybe I need to be more sophisticated. The source text wisely runs this exact comparison, showing that doubling your expected return on a small starting contribution often improves the outcome much less than increasing the monthly contribution itself. Fay-Felicite Fayturn 51 file 0 Fay, that is not only true mathematically, it is an important behavioral safeguard, because in the first stage, the temptation to pursue a higher rate usually leads people into risk they do not understand, volatility they cannot emotionally tolerate, and choices that eventually cause them to abandon the whole project. A person does not usually blow up his life because he patiently increased his monthly contribution by $100. He often does blow up his financial behavior because he started chasing returns before he had even built a real base. This is why I prefer what I would call the contribution race, not the return race. The contribution race: how fast can you grow the monthly amount without wrecking the rest of your life? How much more can you direct toward ownership as income rises? How many leaks can you stop? How much can you automate? How can you capture half of each raise instead of allowing the full raise to disappear into lifestyle inflation? Those are adult questions, and they are the questions that matter most before the pile has real mass. The source text says something else I strongly agree with. It says the real goal of the early years is not merely to invest consistently, but to reach roughly $100,000 as fast as responsibly possible, because that is the region where compounding begins to feel real. Fay-Felicite Fayturn 51 file 0 Fay. I would phrase it a little differently. But the principle is correct. There is a threshold zone, often somewhere around $100,000 to $150,000, where the emotional character of the machine changes. That is the point at which the investor stops feeling like he is dragging compounding behind him and starts feeling that compounding is finally willing to push. At $100,000, an 8% return is $8,000 per year. Now, $8,000 may not retire you, but $8,000 is no longer an insulting number. It is real enough to be felt. It can pay bills. It can offset contributions meaningfully. It can change how you interpret the whole process, and interpretation matters. The first time a person sees that his account has added a meaningful sum without requiring him to labor directly for each dollar, something shifts in the mind. The mechanism stops feeling theoretical. The snowball metaphor stops sounding like a children's book. Now the machine is recognizably helping. That is what most beginners need to experience before their faith in the process becomes emotionally durable. And to reach that stage, the monthly input matters more than almost anything else. This is why I dislike financial advice that flatters the saver but hides the practical truth. Start small and be consistent is incomplete advice. It should be followed immediately by, and then increase the contribution whenever life allows, because the contribution is doing most of the real work early. That is the honest version. The source text repeatedly returns to this point, saying that the early stage is dominated by inputs, not by rates, and that the investor himself is effectively the engine during this period. Fay turn 51 file 0 Fay, that is the right metaphor. In the beginning, you are the engine, your paycheck is the source, your discipline is the force, the market is only a helper. Later, if you persist and build enough mass, the roles reverse. Eventually, the market becomes the larger engine, and your contributions become the smaller one. That handoff is the whole miracle. But miracles in finance are almost always delayed transitions hiding inside boring repetition. That is why people miss them. Let me state it even more plainly. The first stage of compounding is not the compounding stage in the emotional sense. It is the base building stage. The real task there is not to admire the returns. The task is to survive boredom, to survive the insult of small visible progress, to survive the temptation to chase risk, to survive comparison with people who are already in a later stage, to survive your own private disappointment. When you realize that the first few years of disciplined investing do not make you feel rich at all. If you can survive that stage, you have done something rare. Most people will not. That is one reason so few ever reach the stage where compounding becomes obvious. It is not reserved for the privileged. It is reserved for those who survive long enough and feed it heavily enough to let the math finally show its face. I want to say something here about comparison. The source text closes on a very important behavioral point. Do not compare your chapter 1 to someone else. Chapter 15, Fay turn 51 file 0 Fay. That is exactly right. The person showing screenshots of portfolio gains that now exceed your annual salary did not begin there. He had a long season where nothing looked impressive. A long season where the account was too small for the rate to matter. A long season where he had to keep contributing while the results still looked trivial. That is the season people never post because it is visually boring, but it is the season that matters most. If you do not understand this, social media will ruin your investment behavior. You will look at your own $100 gain and feel humiliated by another person's $8,000 month. That is foolish. You are not seeing the same stage. And in money, stages matter. The seed and the tree obey the same biological law, but they do not look equally impressive to the eye. That does not mean the seed is failing. It means it is early. Now, because I care more about behavior than slogans, I want to talk about what an ordinary person should actually do with this truth. First, stop expecting the early phase to feel amazing. That is probably the most valuable correction you can make. If you know in advance that the first years may feel slow, then you stop treating slowness as betrayal. You treat it as structure. Second, increase the contribution with more seriousness than you increase your interest in return. Chasing the source text gives a practical challenge of asking what it would take to add even $50 more this month. Fay turn 51 file 0 Fay like that. Small increases matter. $50 does not sound like a revolution, but at 8% over 20 years, $50 extra a month compounds into a sum large enough to change the life of the later self. This is how adults should think about money. Not in giant fantasies, in repeated increases, then 50 more. Then another 50 after the next raise. Then 100 redirected from a subscription cluster or some forgotten leak in the monthly system. That is how the base gets built. The source text also says something very sensible about not letting lifestyle expand all the way with income, and instead capturing a share of every raise, even suggesting half as a practical rule. Fe Felicite Fe Turn 51 File 0 Fe, that is exactly how you escape the early stage trap faster. Because the person who keeps contribution flat while income rises slowly is extending the invisible period unnecessarily. The person who raises the monthly input as earnings improve is compressing the time until the machine becomes recognizably helpful. I have always thought of raises as one of the great tests of adulthood. A raise reveals whether a person thinks like a consumer or a builder. The consumer experiences the raise as permission. The builder experiences it as fuel. Permission expands lifestyle. Fuel expands the pile. Only one of those paths gets easier with time. Third, automate. This sounds small. It is not. The source text is right to say that investing should be treated like a fixed bill and move before the rest of life gets a vote. Fe Felicite Fe Turn 51 File 0 Fe. I could not agree more. If the contribution depends on what is left over at the end of the month will usually win, because modern life is designed to absorb whatever you leave unassigned. Automatic transfers protect future ownership from present improvisation. That is one of the highest return pieces of financial engineering available to ordinary people. Make the contribution happen on the same day the paycheck lands if possible. Do not admire the plan, install it. There is a very large difference between admiring discipline and automating it. Fourth, respect the threshold. I do not mean worship it as some magic number. I mean understand what it means. A person below the threshold is still in the contribution phase. He should not expect compounding to be doing the heavy lifting yet. A person near the threshold is approaching the transition, and a person above it is living in the early stage of a new reality where the market's contribution to annual growth begins to compete seriously with or exceed his own. Those are different strategic and emotional landscapes. People who do not know which landscape they are and keep making category errors, they think they need more excitement when they really need more contributions. They think they need a better stock when they really need a bigger pile. That misunderstanding costs years. Let me also say something about rates of return, because this is another place where beginners injure themselves. A person with a small account often behaves as though the answer to everything lies in a more aggressive expected return. He sees 8% as dull. He wants 15, he wants 20. He wants the kind of number that makes a tiny base feel important quickly. That desire is understandable. It is also dangerous. The source material does a very good job exposing this fantasy by comparing a doubled return rate to a larger monthly contribution and showing that early on the contribution increase often produces the more meaningful improvement anyway. Fe Felicite Fe Turn 51 File 0 Fe. That is exactly the point. Chasing a high rate on a small base often creates more behavioral risk than economic reward. A doubled expected return on a tiny account can still lead to an outcome that feels unimpressive if the base remains too small. And because the path to that higher return is usually rougher, the investor often ends up bailing out in a drawdown, locking in losses, and punishing himself twice. This is why I say the first stage belongs to behavior, not brilliance. You do not need to prove you are exceptional. You need to become reliable. Reliability is what gets you to the handoff. Once the handoff comes, then the machine begins to show gratitude. Before that, it asks for faith and fuel. That is a hard trade, but it is the only trade that consistently works for the ordinary person. Now, I want to address something subtle. Some readers will hear all of this and think the message is discouraging. It is not. It is relieving. It means the beginner who feels unimpressed by early results is not broken. He is not cursed. He is not doing something fundamentally wrong if the base is still small and the returns still feel irrelevant. He is simply early. That is a very different diagnosis. And the solution to being early is not despair. It is continuation with slightly improved structure, higher contributions where possible, less lifestyle creep, better automation, more patience, less comparison, more understanding of what stage you are actually in. This is why I have always preferred accurate pessimism to exaggerated optimism. Accurate pessimism says the first stage is harder and slower than people admit. Fine. Now that we know that, we can survive it. Exaggerated optimism says start tiny and soon it will all feel magical. That breeds disappointment. Disappointment breeds quitting. Quitting destroys the whole enterprise. So yes, there is a practical floor. There is a zone below which compounding is real but emotionally almost invisible. There is a threshold where the relationship changes and the process begins to feel like something other than a noble hobby. There is a point where the annual return becomes a number with actual emotional force. And there is a very long stretch of contributions, boredom, and repetition before that point for most ordinary people. The source text says the path has two phases, a contribution phase and a compounding phase. Fe phalocite, fe turn 51 file 0 fe. I think that is a useful simplification. In the first phase, your savings rate matters more than almost anything else. In the second phase, the balance begins doing work big enough to feel autonomous. What people call money working for you is mostly a late-stage sensation. That is important because the average worker hears that phrase far too early and then becomes confused when his own experience does not match it. Money is not yet working for him in the way he imagined. Not because the principle is false, because the pile is too small. This is why I am less impressed by how early someone started than by how seriously he fed the machine once he began. Time matters enormously, of course. I will never deny that. A dollar invested at 25 has a different life than a dollar invested at 45. But within the time you do have, the contribution rate remains one of the strongest levers. The person who starts at 30 and contributes aggressively can often outrun the person who started at 23, but treated investing like a symbolic hobby. That is the comforting truth inside this otherwise uncomfortable conversation. It means you still have agency, real agency. You may not be able to control the market. You may not be able to turn 8% into 16% by force of will, but you can often influence the monthly flow into the machine far more than you think, especially once you stop pretending that the early phase is supposed to feel glamorous. That is why I say the early phase is not about glamour. It is about obedience to the plan, month after month, paycheck after paycheck, raise after raise. Not because it feels rewarding, because the machine must be fed until it reaches a size where the reward becomes visible. Only then does the public finally call it powerful. I call it faithful. There is one more thing the source text gets right, and I want to end there. It says the beginning is slow, and almost no one talks about how slow it really is. Fe phalocite, fe turn 51 file 0 fe, that is the truth. The beginning is slow. The beginning is awkward. The beginning is emotionally dry. The beginning often feels like you are doing much more for your future than your future is willing to do back for you. That is why so few keep going. But the people who do keep going eventually discover something remarkable. The same process that once felt insulting becomes the most generous thing in their financial life. The same account that once seemed too small to matter becomes large enough that ordinary market behavior produces meaningful annual progress. The same monthly contribution that once looked pathetic in isolation turns out to have been the series of bricks that made the whole machine possible. That is the handoff. That is the change. That is the reason to continue when the early stage still feels cold. Most people want compounding to prove itself first before they give it their loyalty. That is not how it works. You give it loyalty first, then much later, if you were patient enough, it proves itself. And once you understand that sequence, you stop asking the early years to flatter you. You start asking them to build the pile. That is a much more intelligent way to live with the math. And in the end, intelligent patience is what wealth building usually asks of ordinary people long before it gives them anything that looks extraordinary.